Hello, this is Julia Burdett with Nest Realty.
And I'm Parker Knudsen with Plum Dog Financial.
We're going to talk to you today about what influences interest rates and why you should care. You're just going to have to let me move this down. Interest is the amount it costs to borrow money for a specific amount of time. And several things influence that and why it changes either up or down. As with most economic policies, supply and demand is the main reason that things change. The amount of money available, that's both the amount of money that we have as consumers, but also that the banks have to lend overall. Government money policy, we most often hear this about the Federal Reserve rate hikes or changes. Parker will explain more about that in a minute. And the rate of inflation, which we see directly tied to what is happening with interest. And I'll go over that a little bit more at the end. Parker's going to talk now about funds.
So what is the federal funds rate, and why do we keep hearing all this news about feds increasing by 25 basis points, 50 basis points, so forth? So in general, the federal funds rate is an interest rate set by the Federal Reserve to indirectly manage interest rates, inflation, and unemployment. And how does that work? You know, a lot of people might think there might just be one guy in a big tower deciding what the rates are going to be that day. I'd like to say there's definitely a lot more data and strategy and methodical thoughtness into why these things work. However, sometimes it doesn't feel that way. So in general, the feds meet 8 times a year to discuss current conditions about mortgages in the current environment. Throughout last year, we heard rate increase, rate increase, rate increase. And yes, they did pretty much increase that rate anytime they had met. It is not promised that they will increase or decrease these rates every time they do meet. However, this is the current environment that we've been in. In general, economics, as health goes, we want to increase 2% inflation rates on an annual basis. Now, while we've been at the gas pump, we've seen eggs, we've seen a lot of different goods increase over the past year. One of the ways we're trying to combat that inflation is through mortgages. And also, we're also trying to help control the short-term rates like savings and CDs. So how does it affect mortgages, and how does it affect your pocket? Typically, financial institutions base their consumer interest rates based on the federal rates. And if we could just kind of think about this as a normal business, if they're able to buy these rates, they will typically increase some X amount, so they're able to replenish their savings and keep lending money to the consumers. In general, again, not concrete, but the best prime rate for low-risk customers is the Fed rate, plus around 3% or so. And when the federal rates go up, consumer rates typically go up. And purchasing is much more expensive, the demand decreases, which increases the supply and lowers the prices. Here in Asheville in Western North Carolina, again, it's not concrete that these things are influential on each other, but we are seeing these changes and we're feeling them on the consumer side. This change isn't immediately felt, however, and most economists and mortgage professionals will say that each increase that happens, the full ripple effect doesn't happen until 6 to 12 months later. Looking at this historical chart, and you'll see and you'll hear it from Uncle Jim and Aunt Jody, oh, the interest rates today aren't near what I had when I first bought my house in the 1980s. Yes, that is true. And if we look at the timeline over these 62 years, that average is actually 7 3/4. Today's rates, we are lower than that. However, you can see in the past, they've been much, much higher than that 7 3/4 rate. What was really hard to grasp for consumers, as well as professionals in real estate and in mortgage, is how fast we saw these increases last year. You know, we saw increases double and almost triple in 1 year. And a lot of people were scrambling and wondering why this was happening. Inflation has been kind of spinning out of control for a while. And again, a lot of the global market and especially US economy is tied to mortgages, and we can try to help combat this inflation through mortgages.
And we do see that interest rates and inflation tend to follow each other pretty closely. So just a reminder, inflation is the rise in prices, which can be translated into a decline in purchasing power over time. Recent influences, we all know about the supply chain issues. I'm sure you have felt that in many different ways. That's a global problem. There's more spending money available. Now, we may not think that directly, but because of stimulus checks and wage increases that are out there, there's more money in the economy, and that tends to lead to inflation as well. But there can be some benefits from this. It's not all bad news. Savings rate increases and bond rate increases, which means for all money that's invested and saved in those packages, you are making more money. Equity in your property increases. You see that when you check your Zillow balance, and you better be calling me instead of Zillow, that's gone up. You have more money in your property. The interest also helps to stabilize rapid home increases. So the prices that went up 33%, 21% in the last few years, that's not stable long-term growth. And so this helps bring it back to a manageable amount that is more healthy for the long term. So what's the bottom line? Yes, the sudden change was shocking. Yes, it's not going to change again anytime soon. This is the new normal. But real estate is still one of the best long-term investments that you can have. We see the price of goods that have increased in the last year from February 22 until February 23. And in some areas, I'm sure you're telling me it's even more than that. But I want to talk for a second about what happens to cash on hand during an inflation. So if you have that sitting in a bank, you have $1 million, 8.5% inflation is going to take that to $915,000 the next year. Let's take it one more year farther. Well, your cash on hand in the bank has now turned into $837,225. That doesn't look like a very good return on investment, and I wouldn't want to be throwing my money out the window like that. But during the last 6 recession times, these are the increases that we're seeing in the real estate market. 4 out of the 6, they actually still increased, even as your cash in the bank was decreasing. The 90s had some different influential factors, and of course, we all remember 2008 with the complete change that needed to happen in that situation. So those were different. But in the last 3 years, 2020, real estate still went up 6%. You are still gaining money on your investment that is helping your equity improve. So we want to help keep you on that side. If you would like to take that cash out of the bank and not lose it during the inflation that we're having, but actually be able to turn it into more, we got you. We're here. Give us a call. If you or anyone else you know could use help, we want to do that. Take advantage and let it grow for you. I'm Julia Burdett with Nest Realty.
And I'm Parker Knudsen with Plum Dog Financial.
We got you.
We got you.
Give us a call.